Hey guys, Freaky Finance here. Last week we looked at Intel, and just as an update, I did get billed on an Intel order Friday morning. It's a market buy under $49 a share. I listened to a 2.5-hour architect video and decided to buy into it instead of waiting, as originally I was planning to get into that $45 to $47 range. So we'll see if the lack of discipline gets to me. Anyway, today we're going to be taking a look at Canadian oil sands company, specifically Suncor today. So Suncor is a large oil and gas operator, has a large mining site in Fort McMurray that most people know about if they follow Suncor. They also have some offshore oil sites, specifically off of Newfoundland, as well as Northern Europe. Not all oil and gas companies are created equal. You can see that they also have 1,850 Petro-Canada stations, so direct-to-consumer retail sites as well as wholesale sites. Quite a bit of gas stations, and additionally Suncor has a integrated business model, vertically integrated, and that's critical to the investment thesis, as the refineries enable Suncor to find value across the chain, basically converting its base bitumen to a variety of end products. So the producer and refinery capability is it's important to this investment thesis. So you can see 75% of its FFO is from refined products, but there's some processing done. So 25% is processed bitumen to synthetic, and additionally another 50% is refined into end products. So, and if you actually just map it out, you can kind of see that quite a bit of their FFO, 75%, is from their more refined products, is their unprocessed, which is just 25%. So additionally, the 15% is offshore, and that's priced in Brent crude. The other remaining just base bitumen, just 10% of free cash flow is priced at USGC heavy crude. So it's critical to get this in your head when you're thinking about Suncor, because a lot of people just understand that it's an oil producer, but for some reason they don't understand the refinery part of it and how critical it is to its cash flow. You can see here the value added by having that vertical integration. This kind of grayed out part is the margin on each barrel. So you can see that if they don't do anything with it, they're only getting 20. They bump it up to synthetic, on average they're getting 34. And if they bump it up again to say gasoline, get 47. Quite a huge value add for their vertical integration. And more importantly, they can choose what they want at any given time, right? So if something's in low demand here, or they get a better price, they can shift their resources to that area. And just to point out, this is 2019 data, so pre-COVID. All right, and we can see here just the trajectory that they were going. And again, this is pre-COVID, so you're going from basically 6 billion in FFO to 9 billion to 10 billion to 10.8. So things are improving year over year going into COVID. Shareholders are getting quite a bit back. You can see that dividends, about 2.3 billion a year on average, 2.6 in 2019. As well, they started share purchases in 2017, 2018, and 2019. And they were also pretty large. Like, I think that aggregates about 6.5 billion in share repurchases in the last 3 years. Currently, the market cap's only 36 million, so you could argue they bought back 6 divided by 36 of their current market cap, but technically they should have waited and took advantage of the lower share price, but you never know what's going to happen in the commodity market, and obviously things were better for them those last 3 years. So let's take a better look at the financials. So this is just their annual, looking back, and we can see, yes, their revenue slightly went up year over year, but more importantly, the GMD continued to improve, another 2 billion year over year. The SGA did increase, but the additional GMD offset this, so 2019 did see an impairment charge for the Fort Hills site, 2.8 billion, so you can see there, that shoot up. That's non-cash, so you're not going to see that affect the cash flow. Operating income looks like it fell a lot, because it did technically from an accounting point of view, but from a free cash flow point of view, it actually stayed steady. Interest expense on their reporting, they actually vary their forex in there as well, so that's why you can see the swing from 2 billion in cost to 600 million in cost. there's nothing too exciting there. It's just literally their forex exposures. That's something to keep in mind if it's stronger US dollar or not, right? At net income, it's fairly similar, right? But if I were to add back the retirement, obviously 2019 would be way better, and that's usually generally the context of just this higher GMD, right? All right, and the share price did reflect the strength, so over time. You should note now the share price is below 23, so it's fallen a lot since then. We're gonna look at more recent numbers. Just to get an idea of why. But I do want to point out free cash flow going into this pretty high, over $10 billion, right? And of that, they're only having to put in $5 billion back into their business. So the shareholders are virtually getting, well, they were getting about $5 billion back a year, right, out of this company. $3 billion share buybacks just last year, 2.6 in dividends. Basically, all the metrics improved slightly year over year. It looks good. Current quarter, or the Q2 2020 quarter that I just listened to before I jumped on. Not so good. Here, all the red is basically just saying revenue down 65%, revenue down 62% year over year, right? Relative to the previous quarter. So if I add up these, you got 10 billion, and now you're at 4.2 billion. So revenue declined sharply, pretty much $6 billion quarter over quarter. So oil stocks got hammered during COVID, and they're still pretty hammered relative to the rest of the market. And you can see the context why, right? The commodity prices are a huge function of their revenue. And that's not the company's fault, that's industry-wide, right? So basically what I want to do is look at it and say, does this present an opportunity? Because obviously the share price is reflecting the negative news, right? Here we can see the GMB, just the effect on the lower commodity prices, as well as lower production, I should add. They did decrease their production, so that would also eat into the revenue in GMD. But really, it's a function of price. So you can see here, GMD's down $4 billion. Operating SGA though, however, so this is a good thing, also went down 700 million, 650. They did reference the Canadian wage subsidy. So when your revenues, in fact, when your revenues hit pretty hard in COVID, the government would actually come in and pay about 75% of the wages temporarily. And that's still on right now. So basically, if your business is adversely impacted, they're trying to make it so the employer doesn't lay off the employees by subsidizing the wages in the interim. It's a net positive for pretty much every company that keeps a large payroll. So that's one of the reasons why unemployment in Canada isn't as bad, though. I mean, the oil and gas industry is still pretty bad. But anyway, I digress. Depreciation stayed constant, no cash anyway. Aside from the negative GMD of 4 billion swing, they also had another write-down in inventory. That's normally what happens. So last year they saw a write-down in Fort Hills, and that was due to the lower commodity prices. And again, they had another one because commodity prices continued to decline in 2020. And really, I think it's been declining since 2016. Before that, it was declining in 2012. But alright, anyway, you can see the market cap year over year went from 64, pretty much 65 billion to 35 billion. So it's $30 billion cheaper. From a value perspective, if you're trying to get that angle, I mean, it's cheap for a reason. I mean, it just swung down $4 billion in GMD. And I want to point out the cash flow here went from 3 billion in a quarter to 488 million this quarter. So large negative impact, but I thought it was interesting that the cash flow was still positive when you have a revenue decline that high and the 58% or 53% or something like that. It was a huge number anyway. So that's a good thing. Capex was also cut, which is also a good thing in my view. So far, I see SGA cut, Capex cut, and they cut their share buybacks, right? They're half their dividend. I didn't get into that yet, but they did quite a few things. And I view all those things as positive in this environment because it means management is being prudent. They're not just sitting there and being like, oh yeah, oil's going to come back. They're like, okay, if oil doesn't come back, how do we get FFO positive? And they did. So kudos to them for controlling the controllables, I guess, the way to look at that. This could be said for any company. When you could reduce capex by that much, not sure the future implication for production, right? Because they don't just spend capex willy-nilly. It's it's to invest in the business, right? To get more production out of their sites or to expand into different sites, or more drilling, etc. All right. But you can see the production decline as well. So it wasn't solely a function of commodity price. GM still healthy. SGA, the ratio is pretty skewed now because of the revenue drop, because it's just SGA divided by revenue. So while they did cut their SGA They couldn't cut it enough in line with the revenue. That'd be hard to do if you have such a big decline in one quarter. That's just the nature of SGA, right? It's quasi-fixed, stickier. What else? All of the metrics actually went down, and that's again a function of the price and lower production. So it's cheaper, but it's cheap for a reason, right? And now we have to figure out if that reason's worth it. I do want to point out their liquidity is good. That's important in this industry. You can see here, liquidity, $9 billion. Their investment still pretty good. Their investment grade rating relative to most of their competitors. Debt to capitalization is a strength here at 37.5, targeting in the 30s, so they want to reduce their debt. We'll see if they can. Right now it's going to be hard with their FFO so low, and their Capex still higher than their FFO, right? The maturity schedule is well staggered, so there shouldn't be any liquidity issues, and I don't think they'll have a problem rolling their debt. And here I just want to point out the effect of the lower commodity prices, just to get it into like, why did it go from 10 billion to 4 billion for the company, right? The revenue. And really it's across the board, but WTI, I'm just going to focus on that one. You can just see it last quarter, 2019, they almost got $60 a barrel, and then they're getting 27.85, so that's a decline of over, what's that, 53%? Yeah, 53%. So huge declines in commodity recognized rate, and that was reflected in the financials, which was then reflected in the share price. And management, I think, has been doing a good job here relative to other companies I've seen so far. You can see here they're able to get their original guidance of FFO break even was $45 US per barrel, and now it's down to 35. So that's not a small feat, right? You can see they've cut their Capex from their 5.7 they wanted to 3.8. They've reduced their operating expenditures to about another billion. That's a hard thing to do. I'm surprised they're able to get a billion out of that. That's important. They're doing all the right things to save money, and their balance sheet should enable them to get through this, at least relative to their competitors. So at the end of the day, they're going to be one of the last ones. Their noose is I'd say their noose is the widest. They have the most area around their neck relative to the other ones. Alright, so the price chart, we can kind of see, if I go back farther, oh, wait, 2008. Well, back in 2008, it was up here, but yeah, no. Great Recession, you can see the demand picture, because everyone's like, well, demand's going to be low, everyone's unemployed, and as well, the commodity price crashed there. But it did shoot back up in 2011, like all the other commodity prices did. And Suncor managed to slowly trend up over this time. It's been pretty decline ever since the August 2018. It's gone from the mid 50s all the way down to the low 40, high 38s. And right around when COVID hit, this thing got smacked, right? So you can see it. So they printed down to 16 in the really fear part. I mean, if Suncor is going bankrupt, the whole oil and gas industry is going to go, right? So that's the one way I look at it. And you can see that it's starting to come back a bit, but lately it's dipped a little, and that's why I started looking at it. So let's go through some pros and cons here to try to wrap up my thoughts. First pro, I believe management has taken appropriate action in the COVID environment to get its free cash flow break even to $45 to $35 a barrel. It cut Capex, it cut SGA, it cut the dividend, it cut the share buyback, right? Doing the right things that it can do, so I like that. The company was able to generate the company was able to generate $488 million in FFO in Q2, despite a total revenue decline of 58% year over year. So I believe this positive FFO is indicative of Suncor's ability to make it through this environment, as the average price realized for Suncor in the Q2 period was only $27.85. Pro 3, the integrated business model can switch the output based on where they see the most value at a given time. So I believe they can decide to process and refine with a relative amount of agility to others on whether to make, say, gas or distillate or asphalt, or just sell the unprocessed bitumen, right? So they have more optionality in their value chain, which will allow them to adapt to a dynamic environment. Alright, and the fourth pro, debt to balance sheet looks strong, especially relative to any other energy competitors. I think CNQ looked pretty good too. Debt is now $18.9 billion, but maturity schedule looks well staggered. It currently has a 37.5% total debt to total capitalization ratio, and the only covenant comes into play at 65% total debt to total cap, so The margin of safety there. The creditors aren't just going to swing in willy-nilly on this one, which is important in this industry at these prices. So they have come back a little bit. And the fifth pro, value. So the company market cap has fallen from 65 to 35 as the market tries to reflect the poor commodity environment. If one believes that oil will eventually recover, then the valuation should follow suit. It's funny that Suncor bought $6.7 billion in shares in the past 3 years, which means technically they effectively bought back 19% of its current market cap, as if it would have waited for today's prices in hindsight, right? Alright, anyway, the first con, Suncor, like the entire industry, is hit with demand and supply shock of COVID. On the call, they mentioned demand decreased 80% for jet fuel, 50% for gasoline, and 25% for diesel between mid-March and mid-April. So those are big numbers. Demand for Suncor's products may be permanently impacted by the COVID shift, i.e. the, say, work from home and the low amount of international travel, both from business as well as leisure, right? You're less likely to get in an airport than you were before COVID, and I'm more likely to stay working at home than going downtown. Con 2, cheap for a reason. So Q2 revenue declined 58% versus the prior year. The FFO went from $3 billion in Q2 2019 to just $488 million in Q2 2020. So the company has been fundamentally hit by COVID. Thus, while the market cap may be down 45-50% year to date, the revenue and the FFO have currently been hit harder if one extrapolates those Q2 results into the future, right? And those Q2 results are pretty bleak. If market does not improve, it could continue to have write-downs in inventory, goodwill, or PPP assets in general. These would continue to hit retained earnings, thus hurting the capitalization, which the debt covenants rely on. There's still a margin of safety there, but it's something to keep your eye on if there's any more large impairments going on, right? The fourth con, so the reduced Q2 FFO of $448 million did not cover the reduced Capex of $685 million, meaning it will have to finance even the reduced Capex amount, likely via debt, so it's probably going to keep taking on a little bit more debt here in the interim, whether it's just through its line or otherwise. The decline in Capex, so the fifth con, the decline in Capex from $1.36 billion in 2019 to $698 million in Q2 2020. Well, it's good for cash flow management currently. In the long run, it may lead to production issues in the future, especially if oil is low for a longer period of time. Note, this is a con for the entire industry, so with that in mind, if enough Capex cut in the industry, it could lead to a cyclical commodity price appreciation. So that's something to think about going forward. So, to conclude my thoughts on Suncor, my thinking is Suncor is a safer way to play a rebound in the oil market, while the oil and gas market has continued to increase relative to its prior lows. If it stays in this range for a prolonged period, Suncor is likely to make it out to the other side relative to the other players in the industry. And given it had more than $68.5 billion in net book value PPE, so that's their property and equipment, it should be able to leverage a strong position size. Additionally, it only had $1.7 billion long-term debt due in 2022 and $1.6 billion due in 2023. So liquidity risk is low, though they will have to roll all this debt if their FFO remains as low as it did in Q2, right? But though that was at a WTI of $27 per barrel for the whole quarter. So Suncor made $10.8 billion in FFO in annual 2019, with that realized price of $57 per barrel for the year. And note that $10.8 billion is just 3.5 times the current fall in market cap. So if things were to ever recover, I mean, you're only paying 3.5 its previous free cash flow, right? Given Suncor was able to generate $488 million in FFO in Q2 with a realized price of just $27.85, it may be likely that the Q2 results will go down as some of the worst possible, especially as we are back above $40 currently. That being said, could easily just go back down to 30, but I mean, they just had a quarter where their average was 27, so it's likely the oil price will not easily make its way back up to pre-COVID levels given the demand uncertainty. But the uncertainty is also pulling Capex from all the oil and gas players, so Suncor isn't the only one who slashed their Capex by $2 billion for the year, right? There's a lot of Capex being cut in this industry, which means eventually there should be a supply decline. Eventually. There's still a supply overhang right now, but eventually there should be a decline. If a vaccine does not come right away, I would imagine demand stays down, and a lack of future investment would slowly support the price. Additionally, the continued printing of US dollars should also subtly support the price as the United States continues to print money to bridge the income shock due to their high unemployment. And that's a play more on the currency that oil is just denominated in, right? And that could be said for any commodities. If more and more COVID cases continue in the fall and they can't get their shutdown, and say that going back to school increases the cases and all that, right? And then you have your flu season buried in there. It could say that they're just going to keep printing more money in the interim, and I think that's a safe assumption, but we'll see. And that will further obviously dilute the US dollar, weakening it and supporting the price steadily for oil and gas companies. Eventually, if prices stay at this level, there should be a time where supply eventually peters down and the underinvestment in Capex, as all the oil companies currently try to save cash and lower the FFO break even, just like Suncor did to get their FFO break even from 45 to 35, right? It's hard for me to decide to buy or not, as it feels like I am guessing on what the demand and supply picture will be in 2021 to 2023. Over a longer period of time, I think it's one of the best ways to play a recovery in the oil commodity market. Given a stronger financial position, it's probably a buy. I haven't put a bid in yet, but I might next week. I'm still going back and forth on how I think about the industry. I have a feeling there will be like a cyclical upturn over time. I just don't know when. And so it's hard to get a catalyst to be like, why buy it now? Why not buy it when I know more information? But I'm thinking about it anyway. So let me know your thoughts on Suncor. On paper, it looks like one of the best ways to play the oil and gas industry in Canada. And the second one I was looking at was Canadian Natural Resources. That's ticker CNQ. But at the end, Suncor edged out for me, so I decided to do a video on it. Alright, well thanks and have a great day.